Everybody. Everybody.
Good morning and welcome to NYC TV Live. I'm Trinity Chavez, and today is Thursday, August 1st, and we're coming to you from the New York Stock Exchange, the epicenter of global financial markets. And in just about 30 minutes, charity organization A Moment of Magic will ring the opening bell and open up the U.S. equity markets for the day. Now, A Moment of Magic is a New York City-based nonprofit organization on a mission to improve the quality of life for vulnerable and underserved children and inspire them to be brave, strong, and fearless through fun and engaging social wellness activities. And it isn't just by creating fun, but they also empower experiences for children that contribute to their emotional, mental well-being, self-confidence, and self-esteem. A Moment of Magic says that more than 150,000 children have been impacted by the organization since 2014. It has 325 hospital and nonprofit partners across the United States, as well as 1,400 college volunteers. Overall, the organization says that it averages 18 hospital visits and programs each week. Now we're going to switch gears a little bit, but after A Moment of Magic rings the opening bell this morning, the ensuing of 6.5 hours of trading will be specifically busy. Investors have had a chance to sleep on Federal Chair Jerome Powell's comments following the central bank's decision to leave rates unchanged Wednesday afternoon. Currently, interest rates are sitting at their highest level in more than 2 decades. But today's activity won't only be impacted by the Fed. Earnings season is in full swing, and Wall Street is bracing for a slew of earnings after the closing bell, specifically in the tech sector. Now, investors are also bracing for fresh employment data that will arrive Friday morning. And just last month, the Bureau of Labor Statistics revealed that job growth in June slowed compared to the previous month, while the unemployment rate rose to 4.1%. Now, let's kick things off with the Fed. In a wildly anticipated move, the Federal Reserve kept interest rates at 5.25% to 5.5%. Now, the Fed hasn't moved rates since last July, and its borrowing costs remain at their highest level in 23 years. But could that be changing soon? When asked about the possibility of a rate cut in September, Fed Chair Jerome Powell said the following to reporters, quote, "The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September." Joining me now is Art Hogan, Chief Market Strategist for B. Riley Wealth Management. Good morning.
Good morning.
It's great to have you on the show this morning. Now, let's just dive into this. So Jerome Powell signaled that we could see a rate cut in September. While this would, of course, be a huge news, have investors already been pricing this in?
Yeah, that's an excellent question. I would say that if you look at the Fed Fund Futures or the CME FedWatch tool, the consensus really has been that the Fed's going to cut in September, and I think that's been driven by the fact that we've got better or improving inflation data in the second quarter versus the first quarter. So for the first time in a cycle, there's nearly 100% chance, according to Fed Fund Futures, that they cut in September, which is the largest percentage we've seen throughout the entire cycle. And I think that the Fed will have plenty of information by the time that they meet on September 18th to make that decision. And I think that that's going to be the start of a trend where we have 25 basis points at least every quarter for the next 18 months to eventually get the Fed funds rate down to, call it 3.75% to 4%.
And let's say the Fed does begin cutting rates in September. Do you anticipate that we could end up seeing 2 or possibly 3 cuts by the end of 2024?
Yeah, I think the interesting setup for the Fed is at both the September meeting and the December meeting, they'll be disseminating more news. They put out what's called the Summary of Economic Projections, so we'll get a fresh update from all 18 of the FOMC members as to where they think monetary policy will be, inflation, GDP growth. So they have more news to share with us at those meetings. So we think that both the September and December meetings, they will likely cut by 25 basis points, and that'll be the start of a trend where we will, for most of 2025, we're going to see a rate cut at least once a quarter.
And you know, we'd be remiss if we didn't mention, of course, the presidential election just 3 months away. Now, the Fed has previously said that it's politically independent, but do you believe that policy decisions and other related Fed speak will sway voters over the next 3 months?
No, it's hard to say that a 25 basis point cut in monetary policy with long and variable lags is going to have an immediate impact, or certainly an impact on the economy, before the November 5th election. So I think it's safe to say all of the meetings for the rest of this year are live. I don't think the Fed has to worry about swaying public opinion or political opinion whatsoever. I just think they need to start after having kept rates at 5.25 to 5.5 for the last year. It's time, and inflation is certainly working in the direction. They've made significant progress towards their goals.
And you know, of course, the Fed decision is the major economic headline of the week so far, but more news is coming out this week. The July jobs report drops on Friday morning. So what do you think investors are looking out for here, and how much do you think this will impact the Fed's mindset?
Yeah, I think we want to see a continuation of the normalization of jobs creation. So in the first quarter of this year, on a 3-month average basis, we were creating about 250,000 jobs a month, and that's worked its way down to about 175,000 jobs a month, or thereabouts, on a 3-month average. So I think that's the perfect number, somewhere between 125 and 175,000 jobs a month, to keep unemployment, or keep employment full. I think the one wild card that may come in, and this came up in the press conference, is if in fact the unemployment rate ticks up to 4.2%, there's a technical rule called the SOM rule that actually is a recession indicator. There was a question during the press conference, and Jay Powell pushed back on that and said that, listen, most of the recession indicators haven't been very good in this cycle. But that's one of the wild cards on a sleepy Friday afternoon in the summertime that might cause some volatility.
And another major item this week is obviously earnings. So how are investors pricing this out as data rolls in?
Well, I'll tell you this, the start of earnings season, at least as it pertains to the mega caps, was pretty sloppy with both Tesla and Alphabet, but that seems to have calmed down a bit. And I think the real theme amongst the hyperscalers has been that if you can tell us what you're going to do with artificial intelligence, how you're going to actually drive revenue growth, if you can show us that this CapEx is actually worthwhile and will have a return on investment, companies have been rewarded. So we saw that last night with Meta. We'll likely see a similar effect with both Apple and Amazon after the close tonight. But it was pretty choppy a week ago, and we certainly had a significant sell-off in the technology and communication services. That seems to have stabilized, and we'll see how Apple and Amazon do after the close tonight.
A lot to look out for. Thank you so much for joining us today.
Thank you.
Now, the current interest rate environment has been presenting new challenges to companies over the past couple of years. And it's something SalesLoft CEO David Obran discussed with Judy Shaw recently on the trading floor. Let's take a look.
Joining me today on NYSE Floor Talk is David Obran. He is the CEO at SalesLoft. David, fantastic to have you here. Thanks for joining me.
Pleasure to be here. Thanks for having me.
So let's start off by talking about the company. What is SalesLoft?
SalesLoft is a global software company, and we build what's called a revenue orchestration platform. And what this is it is a fancy term for a workflow platform for your go-to-market teams. So anybody that is engaging with your prospects and your customers leverages our platform to determine what their buyers are doing, how to best engage with their buyers, and how to drive repeatable outcomes.
Now tell me, what are the biggest challenges for enterprise revenue teams?
It's a great question. So today we're seeing a very different set of dynamics than we've seen in the market over the past few years. Rising interest rates, in the low interest rate and COVID environment, many companies overspent on their tech stack. And so right now, enterprise teams are struggling with a couple of things. One is how to build their pipeline. Buyers today are more digitally empowered than they ever have. So sellers have to actually find buyers in market and meet them where they're at. That's a tough thing to do. The other thing enterprise teams need to do is figure out how to engage with those buyers with a great degree of insight and context in every interaction to build those strong, mutually beneficial outcomes. And so this is a tough time. Right now in low interest rate environments in the past, inbound leads came to you, people were overspending because they had huge budgets. None of those things now are true. And so you've got to be able to find where your buyers are, figure out how to engage with them with context, and figure out how to do that in a consistent and repeatable way so you drive the right outcomes, both for your own company and for your customers.
Now, SalesLoft acquired Drift earlier this year. Now tell me a little bit about why you made this move and how's the integration go?
It's a great question. So if you're building a revenue orchestration platform, by definition, you are trying to transform how sales is done. Well, sales is a two-way street, right? You have buyers and sellers. So building revenue orchestration platforms, you can't just build for sellers. You have to take buyers into consideration as well. This is why we acquired Drift. Drift was best in class in their category. They have deep insights into buyers, where they are and what they're looking for. And we now natively can funnel that information into the platform to the benefit of sellers, but also now sellers have that rich insight and context. So when they do engage with buyers, they do it in a way that drives value in every interaction for those buyers.
Now, you also announced earlier this year that you're building an integration with IBM's Watson X, IBM's AI and data platform. What benefits do you expect to see from this?
We are so early in this AI revolution. And it's unclear who's going to win. You have big LLMs out there. You have smaller language models that are purpose-built for specific tasks or subject areas. And it's imperative for any company that is building a platform that has AI in it to be able to build in a plug-and-play model, meaning that you've got to be able to swap out different AI platforms and different AI models depending on the problem that you're trying to solve. And so for us, we have our own native AI, but we've also built a plug-and-play architecture that allows for Watson X, that allows for OpenAI, and we'll have other AI models that plug and play as well. But there are many large companies around the world that depend on IBM and want to buy IBM technology, and we want to make sure that we serve those. We do not want to have a proprietary model that excludes any customers from being able to leverage our platform in a way that deeply coexists with their existing technology investments.
And borrowing costs impact a wide range of industries and sectors, including the housing sector. It's something our parent company, ICE, has been closely monitoring too. According to ICE Mortgage, the average 30-year mortgage rate currently sits at 6.72%. Andy Walden, the Vice President of Enterprise Research Strategy at ICE, is joining me now. Good morning, Andy.
Hey, good morning, Trinity.
Great to have you. So let's just dive in here. So how do you expect what we saw from the Fed yesterday to impact 30-year mortgage rates?
Yeah, and as you were just discussing, it's not necessarily what the Fed did, right? We know the Fed kept rates stable. It's more the Fed tone and the words that they used yesterday that's kind of reaffirmed the suspicion that the Fed will begin easing rates in September. When we look at how the bond market has reacted, bond yields, especially 10-year bond yields, which tend to drive mortgage rates, down a few basis points from where they were yesterday, which suggests that ICE conforming rate that you just showed, 6 3/4 roughly, could drop a few basis points, get down into the 6 2/3 range. Now, I think the broader question is, does that change long run expectations for the mortgage market? You look at composite rate forecasts there for rates in the 6 2/3 range by the end of this year, low 6% range by the end of next year. Maybe this pulls those down slightly, but that's kind of what we're looking at here over the next few months and next few quarters, is rates kind of gradually easing as we move towards the tail end of this year and throughout 2025.
And what does that current rate outlook mean for mortgage lending and the broader housing market as we make our way through the tail end of the year?
Yeah, it's a good question, right? And when you look at the housing market and you look at our latest ICE Home Price Index, the housing market has been cooling off here over the last couple of months. We went from a little over a 6% year-over-year home price growth rate back in February. We're now a little over 4% right now. And if you look at how June performed, if we continue to trend at that level, you can see that annual home price growth rate dip into the mid 3% range here over the next few months. Now, the interesting piece about where rates are at right now, right? Given the recent 10-year Treasury declines, 30-year rates are kind of at their lowest level since late January, early February. We had seen a little bit of a heat up, a little bit of an uptick in the housing market last time rates got to this level. And so that kind of begs the question, have we gone from this cooling to potentially a little bit of a a modest reheat out there in the housing market with rates easing a little bit. We'll be watching that closely. We'll be keeping an eye on obviously purchase applications of the demand side. Obviously a little bit more inventory out there right now than there was early this year when we were last at rates at this level, but could see a little bit of a shift in the housing market here over the next couple of months, something worth watching. From a lending perspective, I think that one's interesting as well. Not only are we kind of at the same levels that we were from an interest rate perspective in late January and February, we're almost identical to where we were at this point last year in terms of interest rates. But in terms of refinance incentive, we're in a very different spot because the market has broadly lived above this interest rate range over the last 12 months or so. So when you kind of look at the dynamics of the mortgage market, there are twice as many in-the-money borrowers today as there were a year ago. There are 3 times as many highly qualified refinance candidates as there were a year ago. So perhaps some modest growth here over the next few weeks in refinance activity. And I kind of emphasize modest. We're still talking historically low levels, but a little bit of a positive storyline there for refinance lending in the market.
And I understand you're going to be speaking about the latest on homeowner equity on your monthly mortgage monitor call this afternoon. And there are some interesting tie-ins there as it pertains to the Fed expectations, right? So can you give us a little preview on the latest data and what it's showing out there?
Yeah, absolutely, right. And we've seen mortgage debt gradually rise here over the last few quarters. We actually hit a record high here in terms of total first and second lien mortgage debt in June, but what you've seen is home price growth outpacing that debt growth, and that means strong equity positions. Mortgage holders out there have $17.5 trillion of overall equity, the strongest level we've ever seen. $11.5 trillion of that is what we call tappable, meaning that could be borrowed against while still maintaining a 20% equity cushion on every property in the U.S., also a record high. And then when you look at debt leverage in the market, it's still relatively low, right? The mortgage market is about 44% debt, 56% equity right now, which means lower loss risk out there in the market. And the tie-in that you mentioned at the Fed meeting is those Fed interest rate dynamics, specifically drive second lien home equity interest rates out there in the market. And as the Fed has raised interest rates, those second lien HELOC rate offerings have been in the low 9% ranges in the early stages of this year. If you look at that Fed dot path, right, or that dot plot or future Fed rate path that you were discussing earlier, it says over the next 15 months, maybe a 1.5% to 2% decline in the Fed funds rate. That could directly impact the interest rate offerings on those second lien products, right? So instead of low 9% home equity lines of credit, we could be talking mid 7% as we get into late 2025. Could spur a little bit more activity out there in terms of second lien equity utilization, renovation activity, and the like.
A lot of important information right there. Thank you so much, Andy, for joining us.
Absolutely. Thanks for having me.
Now, for people who are interested in joining in on that Mortgage Monitor call this afternoon, where Andy will be discussing the latest and greatest on mortgage and the housing market trends, you can register by scanning the QR code right here on this screen. Here's a little closer look at how ICE Mortgage is using data science to change the game.
Data science can help address some of the biggest challenges in the financial markets. If we focus on the mortgage market and follow the life of a loan from origination right through its pricing in the capital markets, our data science capabilities can provide a deep level of insight and analysis to a variety of stakeholders.
At ICE, we have extensive data sets, especially around 3 pillars: the property, the mortgage, and mortgage performance. This trifecta of data and its history is a bit of a data scientist's holy grail. Let's imagine a single property for a moment, 123 Main Street. And before mortgage is a twinkle in its originator's eye, we can apply data science to gather and curate detail about the property and its transaction history. Once a mortgage is originated, it will land in a portfolio, either as a whole loan or as part of a mortgage-backed security. Data science and analytics actually allows us to provide insights along the way to the performance of that mortgage, prepayment, default, forbearance, even natural payoff, updated values, tax estimates, and we can also measure what's going on in the market around the property or things that may impact the performance of that mortgage. As that loan on 123 Main Street is transacted, data science will be used to identify further risk and opportunity.
Quantifying loan level climate risk requires knowing a suite of information about the property being mortgaged. We also need to model how severe a given hazard, like wildfire or flooding, will be both now and in the future at that specific location. Bringing all of this data together to quantify loan-level climate risk requires using data science tools to spatially join data sets of different resolutions, address data incompleteness, and build models to infer asset-level risk. The Sustainable Finance team has computed loan-level energy usage, energy bills, and carbon emissions, a statistic that helps us assess the affordability of a property over the duration of a loan.
The secondary markets are a way for originators to clear loans off their balance sheet. This means that they can take more risk and help more borrowers. That loan that we scored and got performance information about, it would likely end up hedged using a rate lock future on one of the ICE exchanges, and it's probably going to end up in a loan forward vehicle called a TBA. As this loan goes through its life, these models for projecting prepayment and defaults become key in figuring out how the loan will perform on the forward.
More investment flows into funding mortgages and housing, which puts more families in homes and tends to be the most important asset many people will ever own.
And joining me now to continue the conversation on current trends in the housing sector is Danielle Hale, Chief Economist for Realtor.com. Good morning, Danielle.
Good morning.
Now, the Fed has signaled the possibility of cutting rates later on this year. With lower borrowing costs potentially in the fold, how much are we seeing the housing market start to thaw?
Well, we haven't seen a whole lot of thawing yet. Existing home sales have still been pretty low, and new home sales as well. But we started to see a bit of daylight in the pending home sales data in June. Pending home sales are a forward-looking indicator. They're based on a really early stage in the home buying process, and they were up 4.8% in June as mortgage rates drifted lower. So I do think that's a positive sign. It tells us that buyers are still reacting to interest rates, and as mortgage rates come down, that improves affordability, and we will see buyers react.
But, how long do you believe that it'll take for the market to normalize?
Yeah, I think there's been a lot of challenges for the housing market. Today, Realtor.com released our July housing trends report. It showed that active inventory, that's the number of homes for sale without any sort of contract to purchase, were up nearly 37% compared to a year ago. So that's a big improvement. And it's at a post-pandemic high. However, it's still down about 30% compared to 2017 to 2019 levels. And even in 2017 to 2019, we were sometimes talking about a housing shortage. So I do think inventory still has a ways to go. Existing homeowners do seem to be deciding to sell and participate in this housing market despite the challenges that they might face. So newly listed homes were up almost 4% in July. So some of the increase that we're seeing in inventory is because we've got more homeowner sellers, but we're also seeing buyers still remain a bit choosier. Interest rates are still relatively high, and so time on market was up a bit. So it's going to take more time before the housing market normalizes. By most indicators, we are taking baby steps in that direction.
Let's dive into that a little bit deeper, what you mean it's going to take some time for it to normalize again. So what does the new normal look like right now in this sector, and where will mortgage rates settle?
Yeah, I think that's a great question. I think the new normal is really going to depend on what happens with construction and housing supply. And I don't just mean existing housing supply, but construction. There are a wide range of estimates that show we haven't had enough new housing created over the last few years. Realtor.com's estimate shows that over the last decade, we're between 2 and 7 million homes short, depending on the assumptions you make about single family versus multifamily supply. And for context, we build between 1 and 1.5 million homes each year. So we have a multi-year gap in the amount of building that's needed to keep the housing market at what might be considered a normal level, with a normal rate of slack, a normal rate of vacancy. And so that's why we've seen price gains, even though prices are already high and affordability is already stretched by high costs and high mortgage rates. So I think how the housing market normalizes is really going to depend on how we can solve this supply shortage and what we're able to do from a construction perspective.
And as we wait for a moment of magic and the whole team there to make their way down to the trading floor so we can show you pictures of the distinguished guest book signing, we're going to continue this conversation, Danielle. So for new home buyers, are you seeing any changes right now in the amount of money put forth for down payments, or are less people putting down 20%?
Yeah, so it has never been the case that the typical buyer puts down 20%. The typical buyer is somewhere between 10 and 20%, sometimes even a little less than 10%. But recently we have seen down payments rise as the market was very competitive. That was one way that buyers could signal that they were serious, is by putting a larger down payment down. We also have seen down payments remain relatively high as mortgage rates have ticked up, because buyers are trying to avoid taking on any more debt than is necessary at high mortgage rates, and also because you've got a lot of buyers that are existing homeowners right now that have very high levels of equity, and so they can translate that equity into a larger down payment and therefore avoid taking on more debt at a higher mortgage rate. And so down payments remain relatively high. That said, there's a wide range. There are a lot of mortgage products for buyers, especially entry-level buyers, who don't have large down payments amassed, and they can still be an important part of accessing the housing market and creating homeownership opportunities for first-time buyers.
Well, a lot of key takeaways there, Danielle. Thank you so much for joining us.
Absolutely.
Now, we are still waiting for those images of A Moment of Magic and their team to come down to the trading floor and sign the Distinguished Guest Book right before they head up to the Bell Podium. Actually, we're seeing them right there. Oh, there they are. Oh, I love that. I mean, it's always a great day at the Exchange when we have kids and families just here, a part of this organization, really doing good in the world, making a difference. And we're right here capturing it all here on the floor of the New York Stock Exchange, giving you all who are watching around the world a glimpse as to what happens inside the confines of the New York Stock Exchange trading floor. Now, switching gears a little bit for a moment, I was just in San Francisco recently at NYSE Pacific covering RSA earlier this spring. I spoke to many leaders in the cybersecurity space about the biggest challenges and the trends we are seeing right now in the sector. Here's what NightDragon founder and CEO Dave DeWalt had to say. We're here on site, your annual NightDragon Innovation Summit. Start by telling our viewers exactly what this event is.
Where we try to bring innovation and mission and community all together. So part of our mission is called Securing Our World for Tomorrow, which is the nice mission to kind of help create peace in this difficult world that we're in. But we also love community.
Tell me about your keynote, Cyber Fusion.
So fusion means cyber is beginning to fuse with other domains. So traditionally, cyber was like your network, your endpoint, your cloud, your mobile phone. But now it's starting to be things like blockchain, supply chain, industrial networks, space, drones, and it's much bigger of a problem. And we got to think about where the future risks and threats are.
What have been some of the top line headlines that you've been discussing with them?
The threat environment is at an all-time high. Regional wars around the world, lots of different, we have 60 countries up for elections, misinformation, disinformation, deep fakes are a big problem in our world and our society. So a lot of threats and risks, and ransomware is high, data loss is high, espionage is high. So it's a little ominous to say, but also we have so many cool new technologies that are coming up. So all this AI enthusiasm, create a counterbalance to the threat is kind of this year's kind of thing.
But talk to me about some of the biggest trends right now that we're seeing in the cybersecurity sector.
There's a big new word, and I think somebody made it up, but it's called platformization. So the idea of creating platforms of security, almost like security as a service. So the largest of largest companies are really trying to create the best of breed in a best of suite as a platform. And there's a lot of controversy over that. And that's going to be a topic of a lot of my innovation summit later, because I'm interviewing some of those cyber titans and really kind of pulling on that.
Now you hear cybersecurity, it's at the forefront of these conversations around the world.
AI has the ability to help us automate things, help us make humans smarter at decision making, and the promise of that is real. The ability to ingest lots of data into large language models to get better at crowd support, really amazing. But then the offense has a lot of tools too.
How do you stay ahead of the curve? How do you remain innovative?
Whoever develops the most powerful AI capabilities has a chance to dominate the world's economies and other things. So here we are again in another fast race, but this time the race is way quicker. And suddenly this race has to be won by much more highly regulated environments.
A lot to look out for. Thank you, Dave, for joining me.
Thanks for having me.
11 gram with $75 bid.
All right, we are on the trading floor right now. I want to point out it is an active trading floor. Look at this. We got, at least 100 people here just right behind me on the floor as we get ready to witness a moment of magic. Ring the opening bell, opening up the U.S. equity markets officially, and trading will begin. And so we are about 15 seconds out from witnessing them ring the opening bell. And again, millions of people from around the world are tuning into this very moment. So actually, let's take a closer look right now, and we'll be right back. All right, the markets are officially open, and now joining me is Alex Kofi, Senior Trading Strategist for Charles Schwab. Good morning.
Good morning. Thanks for having me.
It's a pleasure to have you on the show today. So let's just start diving into this conversation. Jerome Powell signaled that the Fed could cut rates in September. Presuming that happens, what sector should investors be bullish on, or how should they be bearish?
Yeah, this is a good question. And so whenever we're talking about the Fed, we kind of go through a process of what are they going to do? When will they do it? And then finally, we ask, why will they do it? Now that we have the answers to they're probably going to cut and it's probably going to happen in September, as we expected before the meeting and still expect after, the question will be, why are they cutting? In a situation where inflation continues to move lower, the next question is, what happens with the economy? What does the jobs market look like? If growth in the economy stay resilient enough, expect the areas of the market like the tech sector and consumer discretionary perhaps to outperform. But if you don't see the soft landing scenario and you actually see a little bit more of a bumpy landing or possibly even a more of a recessionary type situation, growth going down, inflation going down, then you'd also probably actually look towards the opposite, because consumer discretionary and tech would underperform in that scenario. So you look to areas that are a little bit more defensive, which would be, of course, utilities, healthcare, and consumer staples. So that really is going to come down to the answer to that question of what does the economy do? What does growth look like? And we just don't have the data yet to know for sure.
Now, in the Q2 trader sentiment survey conducted by your firm, 25% of traders anticipated rate cuts of greater than 50 basis points in 2024. So can you see the Fed cutting rates in each of the final 3 meetings of 2024? And if not, what do you think is the timeline and what will that look like come September?
Yeah, so this, of course, was conducted back in April, so it's a little bit older in terms of when this data was actually collected. But about 40% saw, up to 50 basis points, which would be consistent with sort of that maintenance cut scenario, the soft landing scenario, which would perhaps be bullish for the tech sector in that scenario. However, in the scenario that you laid out, which is more than 50 basis points, possibly all 3 of the meetings, that's probably going to be more consistent with a bumpier landing. And so at the time, I think the July meeting was still considered to potentially be live. We're now through that July meeting. So perhaps if you're going to get a situation where we get 75 basis points in cuts in congruence or in order, September, November, December, that's probably a bumpier landing scenario. And maybe not the base case at the moment. Probably looking, as Art said at the top of your program, September, December would be the base case at the moment.
And while the Fed decision and Powell's comments were the biggest headlines during Wednesday's session, we're also in the heart of earnings season. And we understand that you believe that this week's earnings are actually more important for Wall Street. Why is that?
Yeah, I think this ties into what I said. I think the question now is, where does the economy grow? What does growth look like? No longer are we really wondering what the Fed's going to do. So earnings have my focus because they give us a glimpse into what the corporate growth trajectory and the economic trajectory as a whole really looks like. We've had so many of those giant mega caps already report this week, and we saw the impact that they can have. Microsoft gapped down initially. It really sent the market into a tailspin. It was able to recover, and ultimately it's kind of back to where it was pre those earnings, and it's allowed the market to breathe a little bit. Meta jumped after the close and continues to be strong, and that's helped bolster the market here. So as we look to the close today, Apple, Intel, Amazon are going to steal the show, in my mind, in terms of potential market moving factor here for the rest of this week.
And you know, something else that you've also been tracking is the weakness in big tech. So what do you think is driving this sort of narrative, and what moves are investors making as a result of it?
All right, I'm going.
Yeah, the macro front, I think some of it was perhaps an unwind of the Japanese yen carry trade, which did put a little bit of pressure on just assets in the U.S. in general. But as we look ahead now and we look at tech, assuming the growth trajectory stays strong, perhaps investors will see opportunity going into August and beyond in that more beaten up sector. We collected some data as a result of something else from some different clients in terms of trading that are a little bit more actively involved in the markets. And the sector that they were most interested in was the information technology sector. They were markedly less bullish than they were going into July, declined from about 40% saying they were at least somewhat bullish to about 30%. But as we look ahead to August, tech is still in the minds of investors. And you look at the move that a name like NVIDIA made, gapping down to about $100, $100.01, I think, post Microsoft's initial reaction, all the way up to over 121 at one point in the pre-market today. You can still see why these names are so much in focus, as they're so influential on the market. But of course, they've also been the ones that are moving the most.
Well, thanks a lot, Alex, for joining us today. A lot of important information there.
Thank you.
Now we're going to throw to a quick word from our parent company, ICE. We'll be right back.
Together some of the industry's greatest minds to discuss its challenges and opportunities.
It's an exciting time to be in bond markets because there has been a tremendous amount of volatility and an unusual Fed rate hiking cycle, both in terms of the pace and the magnitude of hikes, and what that has meant for yield curves.
There's a lot to look forward to for fixed income investors. Yields are at levels that allow investors to fundamentally change their portfolios in more efficient ways using ETFs.
We're finally at a convection point where we're beginning to see yields be so attractive relative to other asset classes.
So today we talked about active or passive, to be or not to be. And the beauty is that you don't have to pick one. We are observing more and more traditional asset managers launching active ETFs.
Execution strategy is becoming a bigger and bigger part of the portfolio management process. You want to be able to add value through how you execute and when you execute.
We spoke extensively about how ETFs have played a critical role in modernizing the bond market, as a result making it a lot more efficient. There's clearly an indication that there is quite a bit of demand for fixed income, and investors are patiently waiting on the sidelines.
When we talk about the electronification of fixed income markets, we often talk about the three-legged stool. That is the explosive growth of fixed income ETFs, the advent of portfolio trading for large transfers of risk, and the development of pricing algorithms that are providing liquidity to the market. And the combination of those three things is really what has propelled electronification and automation in fixed income markets, and what we think will continue to drive things going forward.
Joining us now is Vince Molinari, founder and CEO of FinTech TV. It's a great morning when we have you on the show, Vince.
I love it, and the energy, it's just amazing to be here on the floor with you, Trinity. Thank you.
Absolutely, and let's talk more about the FinTech space. Tell me about the latest and greatest advancements that are happening right now in this sector.
Look, I think we're now at a paradigm shift where FinTech is going to be embedded into so much of our ecosystem, our financial service market infrastructure, and I think we're beginning to get to the point where people are recognizing that value propositions are changing, valuations are going to change, and it's a new day.
And how would you say that this is resonating with consumers? How are they responding to this?
Well, I think it's all about engagement now, and the consumers are realizing that they're stakeholders in organizations that they believe in and trust, and that's propelling a different valuation model as your consumer is your value proposition, right? That's your distribution, that's your sales channel, and I think you're going to see more and more consumers being rewarded for that loyalty from the companies that they interact with.
Talk to me more about how the valuation model is sort of being redefined and how it's continuously changing in this ever-changing landscape.
Well, that's a phenomenal question. I think people are looking at the value proposition of a community, right? And defining that in different ways, because ultimately that is your distribution pipeline, that is your consumer, and that is your advocacy. So I think people are beginning to realize that the lifetime value of a consumer is much different in a fintech-oriented organization.
And there's been plenty of buzz happening in the cryptocurrency space, including the launch of Spot Ether ETF just last week. So what are we seeing right now when it comes to acceptance?
Listen, I think the launch of first the BTC ETFs and now ETH is a permanent acceptance of blockchain, and the technology is here to stay. The acceptance now that we're in traditional market infrastructure, that intersection of TradFi meets DeFi in a manner that has investable product that's institutional as well as retail. So I think we're going to see that continue, and more ETFs around cryptocurrencies and others being launched across the exchange.
And obviously the 2024 election is happening just 3 months away. How do you foresee this impacting this space before or after the election, for that matter?
Well, I think either way you look at it, Republican or Democratic, there's an embracing of what crypto has to offer and blockchain and the technologies. Trump couldn't have been more clear in his recent speech at Bitcoin Wyoming of what is actually occurring and what he's looking to do, and how it may become a currency reserve or part of our strategic reserves, how he plans to change perhaps the SEC if he's elected the moment he comes in. So I think that bodes very well from having clarity across the stack on crypto digital transformation.
Thank you so much, Vince. Always a pleasure to have you.
Thank you, Trinity. Great to be here.
Absolutely. All right, there's a lot of exciting things unfolding on the floor today, but we're going to give you a glimpse of some more exciting events that happen around the New York Stock Exchange.
Together, we built something truly beautiful in the true iconic notion of what America is all about.
This is our task, this is our mission. We have a clear focus, and we have the ability to be agile and innovate.
It takes years of dedication to get us to this milestone. It is all because of you.
Never doubt that a small group of thoughtful, committed citizens can change the world. It is the only thing that ever has.
To be a woman leader, it's not so easy, but it's easy if the passion and the love is coming from your heart.
The New York Stock Exchange is the symbol of what America is all about. Potential of capitalism, the potential of an American dream.
The only way you can move a society forward is a true expression of freedom.
Kylie McGrain-Zarnock, A Moment of Magic, founder and executive director, is joining me now. Good morning, Kylie.
Good morning.
It's so great to have you. You have an amazing crowd. You guys just rang the opening bell. How are you feeling?
It was unbelievable. Truly a moment of magic.
Truly a moment of magic. I love that. So tell me about the significance in being here at the New York Stock Exchange, opening up the U.S. equity markets when millions of people from around the world are watching who's up there on that bell podium.
This is a dream come true. We started as a college project in my dorm room in the Bronx about 10 years ago, and now to be here today celebrating this major milestone of a decade of service and now impacting 150,000 children in the last 10 years. It's such a dream to celebrate with our community and in such a significant way. I mean, this is just the day of the lifetime.
You know, let's talk more about that. 150,000 children whose lives you are impacting. You have hundreds of thousands of college volunteers who also partake in your organization's good work. So talk to me about the importance of that, celebrating this huge milestone and how you want to continue this success and this momentum.
Absolutely. Every part of a moment of magic really is a community contribution. So whether it's our college students that are volunteering their time or our donors who really make the organization possible, every ounce of this organization is from love and support of our community. So we're here today celebrating, but we'll be back on Wall Street at the end of September, on September 26th for our annual Night of Magic Gala, and that really helps keep that momentum going all year round so we can be around for 10 more years plus.
You beat me to the question because I was going to say give us a little sneak peek as to what we can expect in September, but why did you choose to host this event at the New York Stock Exchange come September?
I think that this is really emblematic of New York City and the tenacity and the grit that it takes to run an organization and the community that brings people together. So for me, the heartbeat of the organization has always been in New York. So to be able to bring our community together to celebrate these amazing kids, our healthcare heroes, our volunteers, I mean, that's really what it's all about. So no better location than here.
I love that. Well, thank you so much for joining me. Congratulations again, and we'll see you back in September.
Yes, definitely. Thank you.
Now we're going to toss it to a quick word, well, actually another word from our parent company, ICE, and we'll be right back.
Learning and development at ICE is all about empowering our employees, leveraging the amazing amount of knowledge that we have across the business.
We've put quite a bit of investment in our programs just in the last couple of years. It's exciting, frankly, at this point where we are.
What I love best about working at ICE is that it's a multinational company with people from all over the world that hold tremendous amount of knowledge and expertise in whatever it is that they do.
Yeah, I've found opportunities in this industry, in this field, to really serve people and to help people with their careers.
I love to teach. I think it's a beautiful position to be in, to share knowledge and to see people get better from what you give them. This company always keeps me on my toes because it's continuously expanding, growing into new fields in the financial landscape.
My favorite part of the job is getting to watch employees grow and develop through their careers. It gives me a great deal of satisfaction when we run a program, for example, and we get impact from people about how it's made a difference professionally, but also how it's made an impact on them personally.
ICE has established itself on its core competencies: integrity, collaboration, communication, leadership, and problem solving.
We tie a lot of our programs back to those core values and the behaviors that support those. I think learning and development really fits within the culture of ICE just by the nature of the organization.
It is up to you to be vigilant, curious, inquisitive, ask questions that will help you succeed in your role.
Joining me now is Nick Ewen, Senior Editorial Director at The Points Sky. Good morning.
Morning. Thanks for having me.
Absolutely. So, let's just dive into this conversation. So on Wednesday, the Fed left rates unchanged, as many people know, the highest rates in over 2 decades. So how much is increasing APRs across the credit card space?
Well, the vast majority of credit cards do have variable APRs, so this does directly impact the interest that consumers are paying on any credit card balances that they are not paying in full at the end of a statement period. So it's really important, if you are carrying a balance you're not paying in full, that you do pay attention, because this will impact the amount of interest that you are paying, not just right now, but in future months as well.
Let's dive into that point a little bit more. What other mistakes are you seeing that people tend to make when it comes to paying off credit card debt?
Well, the first thing is the interest charges. A lot of people don't realize that the interest charges can easily start adding up. They may start small. If you have a $1,000 balance and a 25% APR, over the course of that balance, you're going to look at about $20 in interest. It doesn't seem like a lot, but then it starts to accrue. And as you spend more, as that interest is added into your balance, and you're going to accrue more interest, so it can really snowball. So the biggest thing that we see is people spending beyond their means, going beyond what they can actually afford to pay off, and that can really hurt when it comes to this interest charges over the course of a year.
Yeah, of course. Like you said, it all accrues and it adds up to those big numbers. But some cards over 0% APR for an initial period, such as the first year. When should people be seeking out these credit cards?
Well, 0% APR cards are really great for people who are just getting started, who maybe need to lean in a little bit to learn the ins and outs of the credit card industry, get more comfortable with managing that credit. It's also great if you have a large purchase or even an unexpected expense. I had to, unfortunately, have emergency surgery for my dog earlier this year, and I thankfully had a 0% APR credit card open at the time. So I was able to defer the interest or not pay any interest on that charge and pay it off over time. Now, the key thing I want to point out is you want to be careful that you're opening a 0% card and not a card that offers deferred interest. So a lot of furniture stores, electronics retailers, they will offer you these really attractive financing terms for sometimes 36, 48 months. But that's deferred interest, which means that even if you have $1 left on your balance at the end of that period, you're going to have to pay all of the interest that accrued throughout that entire duration of the promotional period. So really critical to pay attention to whether it's 0% APR where it's no interest versus deferred interest where if you still have a balance, you pay all of that interest for the entire life of that loan.
Are there any specific cards that you would recommend over others when it comes to that 0% APR?
Well, there aren't any real specific cards that are better than another. You really want to look at a couple of different things. First of all, the length of time that you have access to the 0% APR. Some of them are as little as 9 months. Others can even be 21 months. So that gives you a really extended period of time. The other nice thing is if you are struggling with credit card debt, you can actually look at a card that offers 0% APR, not just on purchases, but also on balance transfers. So if you're sitting looking at these high interest rates, paying an APR of 25, 27%, you could be a good candidate to open a card that has no interest on balance transfers, move that high balance from a high interest card to this new card. There's a one-time fee, but then you would have a period of time to pay that off with no additional interest on that balance. You just can't do that with the same bank that you are moving the balance from. So if you have a Chase card, don't get another Chase card. You'll have to get a different issuer. But that could be a great option if someone is really struggling to pay off a balance and they're just looking at interest charges piling up, and piling up.
And what's your take on if somebody liquidates a 0% APR card to pay off their outstanding debt on credit cards that are charging those higher interest rates?
So that's a great option if you want to avoid some of those interest rates. The big thing that you want to look at too is the overall impact that your credit card portfolio has on your credit score. So just because you moved a big balance from a credit card with a high APR to one with a 0% APR on balance transfers so you can pay it off, you still want to keep that initial card open, especially if it's not accruing an annual fee. Your credit score does look at a variety of things, including your payment history, your credit utilization. But your average age of accounts is going to be a key part of that as well. And that credit utilization, if you close a card just because you're not using it, that could actually make you look more risky because you have less available credit to access. So an issuer or a credit reporting agency may say that we're going to drop your score because you're more risky as a potential borrower.
Yeah, you know, that actually brings me to my next point because so many people are like, oh my gosh, I have 10 credit cards. I should close these because I have all of this outstanding debt. However, you should keep it open in that sense, correct? Because if you close out these cards, you appear a high risk to these banks.
Yeah, especially if your card has no annual fee, there's really no added cost. And again, you're not carrying a balance from month to month. The big thing I would say, though, is to make sure that you do charge a little something to that card every few months just to make sure that you keep it active. We saw, especially during the pandemic, when banks started really restricting their underwriting, they actually started unilaterally closing some accounts that had sat kind of dormant and not being used. So I have a couple of cards that I call them my sock drawer cards that I don't actually spend much money on, but I do charge $5 at Amazon every couple of months just to make sure that they remain active and they are contributing to not just my overall credit, but also that average age of accounts that really factors into your credit score, can really help ensure that you remain an attractive borrower.
And your company, The Points Guy, aims to help people maximize travel. So given the state of inflation, should credit card users who earn travel-related points be using them as soon as possible, or should they wait for the right trip? What's your take on this? And do points devalue over time in your experience?
I wish I could say that points don't devalue, but we've actually been facing inflation for a number of years in the rewards industry. So we at the Points Guy always subscribe to an earn and burn philosophy. Generally speaking, your airline miles, your hotel points, your credit card rewards, they are not going to get more valuable as time goes on. So if you're sitting on a huge pool of those miles, a huge pool of those points, now is the time to burn them. Take that trip that you've been putting off for a while, and of course come to the Points Guy and we'll give you all those tips for how to make the most of those for your travels.
Is there a specific window, though, that users should be mindful of, or is it just as soon as they pay off the bill, they see those points hit their account, they should burn them?
Yeah, so it really depends on what award you're looking at. In some cases, you can get a free flight for 10,000, 15,000 miles, but other times, if you're looking to go to Europe, maybe you're looking to fly in a premium cabin, you could be looking at 100,000 or even more. So it really depends on the reward that you're looking at. The big thing, though, is if you're looking at a flight, if you're looking at a possible hotel room, the big thing is that if you see a price today, that may not be the price in a month or a year. So if you can afford that right now and it fits with your budget and your travel plans, go ahead and pull that trigger. It's really important because we have seen instances of overnight award rates on flights or award rates for hotels jumping by 10, 15, even 30%. So use them before they really lose that value.
And last question, best day to book that flight?
That is a myth that we love dispelling here at the Points Guy. There's no actual best day to book a flight. And really the great thing about all the technology that's come into the industry over the last years is there are a lot of ways that you can actually monitor flight prices without having to manually check each and every day. So Google Flights is a great option. Hopper gives you some real great insights. Their algorithm recommends when to book versus when to hold off because they expect prices to drop. So really take advantage of some of those technology tools out there. And you don't even have to worry about timing it to book exactly on Wednesday at 8 a.m. because airlines have gotten really sophisticated with their pricing algorithms, and thankfully there are tools out there that can really help you stay ahead of that and get the best price that you possibly can.
Well, thank you so much for all of that advice. It was a pleasure having you on the show.
Yeah, thanks for having me.
Well, that'll do it for us on NYC TV Live. I'm Trinity Chavez. Have a great day.
In life, I'm reminded that it's not about the destination. It is truly about the journey.
My pleasure to greet you today from the center of the U.S. capital market here at the New York Stock Exchange.
I want to just take a minute and not just talk to the people that are in the room, but I want to speak to the rest of the team around the globe. These are people that made this happen, and I know that there is no way we would be here if it wasn't for you.
Everyone at Flutter is proud to join such a distinguished list of companies on this great stock exchange.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. Look how far we have come. I'm so optimistic about what lies ahead. It has been a privilege to be with you.